Yeah, so sorry about that, sir, but I think we can now proceed. So we said the first step you'll likely be able to undertake when you're having to compute or present financial statement for leases. You'll likely be able to determine the fair value of the lease liability. And how do you calculate this one? You'll take the rental payments, you multiply by the present value interest factor of annuity. Remember, I told you that when you talk about the fair value, is getting the value of this lease at the date at which you're having to commence the lease. And therefore, what is supposed to happen? You're supposed to discount what? The rental payments. And therefore, what will happen? You'll take the 14 million, our figures are actually in thousands. The 14 million multiplied by what? The discounting factor here, which will be 1 minus 1 plus 0.1 over 0.1. I was asking how many periods will they be? Now that this one is actually in arrears. Remember, this one is actually what? In arrears. And I told you there's some difference when you're also having to deal with what? This is in advance. So how many periods will they be? How many periods will you be dealing with here? Now that the lease is actually in arrears. How many periods? It will be 6. 6 is actually correct. Someone could be asking why 6, yet we have 3 years. Remember, these lease payments or rental payments are being received semi-annually. So the lease is for 3 years, but the rental payments are having to be received for what? Semi-annually. So in a year, we have 2 periods because they pay in June and also they actually pay in what? In December. So for each and every year, there are 2 periods. And therefore, the total periods here will likely become what? 6. They likely come to 6. So how much are you having to get when you do the computation? It is -6 actually, -6. -6. How much are you having to get when you do the computation there? You'll get how much? 69.73, 649. 69.73. Of course, you've already put in thousands. It is point, so 0.649. 0.649, around 60,000. So according to what you have actually been given, around 60,000. We'll get 60,973.649. So this is what? The fair value of what? Of the lease liability. The fair value of the lease liability. But remember, already you've actually been given the fair value of the machine, which is actually 60 million. So I told you that the examiner might fail to give you this particular figure here, but this is how you can be able to calculate it. In our question here, he has already rounded off to the nearest 10 million. And it is actually what? 60 million, the value of what? Of the asset. So if you look at step number 2, which is said you should be able to compute the right of use of the assets. Right of use of the asset. So how to get the right of use of the asset? This is step number 2. Remember, step number 1 was the fair value of the lease liability. The right of use of the asset. You will take the fair value of the lease liability, which you've calculated above here. It is coming to 69.70, let's say 974, around there. We just round off to that. Then we said you need to add on any initial payment. In our question, do we have an initial payment? Or we do not have? Charity, do we have an initial payment in our question or we do not have? It is not there. So it simply means this one is what? 0. Also, we said you can be able to add on any initial direct costs. In our question, do we have any initial direct cost? It is not there. It will likely be 0. This is the standard way you can be able to calculate the right of use of the asset, whichever kind of question you've actually been given. That's why I'm even having to put them here, so that when you come across any other question they have given you an initial payment, don't start wondering, how will I be able to calculate the right of use of the asset? You just need to use this standard format to get the right of use of of the asset. And therefore, it means our right of use of the asset here will likely be 69.74. So we have here ROA, or we can say the fair value of the asset of the asset is actually what? 60,974. So these are you could have actually been able to compute and actually arrive at the fair value of what? Of the asset using the requirements under IFRS number 16. But ideally, what the examiner did, he actually already gave you the fair value of the asset by simply having to round off to how much? 60 million. Like just like the same question we actually did yesterday. He actually rounded off to the nearest 10 million and he gave you the fair value of what? Of the asset. So in the exam, if he has already been able to give you the figure you'll be able to apply, use this one, because he has already been able to give you what? The 60 million. But assuming the examiner doesn't actually provide for you the fair value of the asset, you can still be able to compute because already there's a standard having to guide us as to how we can be able to calculate the fair value of the asset. How do you do it? You first of all compute in step number 1 the fair value of the lease liability. How do you do it? Rental payments multiplied by the present value interest factor of annuity. What are we having to do here? We are discounting the rental payments to today when we are commencing the lease. What is the real value of this liability? Because in totality, for us to get the liability, we have to add the rental payments. The liabilities you're having to pay in terms of the rental payments, year 1, year 2, year 3, year 4, like that. So these payments won't be paid immediately by the lessee. They'll be paid periodically. But ideally, under the requirements of IFRS number 6, we have to value this lease liability as of today when we are commencing the lease. And therefore, the reason as to why we're having to discount the future payments, the rental payments, to the date we're having to commence the lease. I told you when you hear about the term, the fair value, we are simply having to talk about today. How much can we be able to value this asset or liability? And therefore, today when you are commencing this lease, we can value this liability or this rental payments or this liability in totality at 60,973,000. The essence of us having to be able to do what? Discounts. And that's why it is required under IFRS number 16, you get the fair value of the lease liability to eventually now come up with what? The right of use of the asset or the fair value of the asset. So the examiner actually already provided for you this particular figure here by simply just having to round off to a good number, which is nearest 10 million, 60 million. Nearest 10 million, 60 million. Can someone tell me? I can't see clearly the board. So are the others able to see the board? User is having to say he's not able to see the board clearly. Maybe you need to increase your screen. Try to increase your screen. If you're using the phone, find a way you can be able to increase your screen. Find a way you can be able to increase what? Your screen. So that's what you can be able to do there. So now that he had already given us the fair value of the asset, let's use what he had actually given us, the 60 million. He had actually rounded off. So the step number 3, we said, what are you going to do next? Who can be able to tell us? What are we going to do next now? What are we going to do next? 𝗖𝗙𝗙𝗘𝗘. What are we going to do next? Now that you've already gotten the right of use of the asset, we calculate what? The depreciation. We calculate the depreciation. So step number 3, get the depreciation. Get the depreciation. And how do we get the depreciation? How do we calculate the depreciation? We said you take what? The ROA. You take the ROA. You divide by the useful life. You divide by the useful life or the lease period. You divide by the useful life or the lease period. There's something very interesting here. You can see the useful life of this asset was how many years? What are you told us the useful life? The machine or general machines under finance lease. It was to make installment payments of 14 million every 6 months. The fair value of the machine was 60 million with an estimated useful life of 3 years. So you've actually been given what? The useful life of what? Of 3 years. That's what you're actually going to use. Usually a useful life of 3 years, which will actually basically still be the same as what? The lease period. It will actually still just be the same as the lease period because you haven't actually been told that maybe this asset was actually returned by the lessee back to the lessor. So it means we'll take this amount you've actually been given here as 60 million, this one, the one the examiner gave you, you'll take 60 million, divide by 3. You'll end up having to get 20,000. This one I don't have to tell you, you tell me, because I can easily see it is exactly what? 20,000. That is what? The depreciation. on the right of use of the asset. So it means each and every year for the next 3 years, this asset is actually going to lose a value of 20,000 as depreciation on what? The right of use of the asset. So when you'll actually be presenting the right of use of the asset in the statement of financial position extract, every year we'll actually be deducting 20,000 as what? As the depreciation. We'll be deducting 20,000 as the depreciation. Then we need to go to the next step. What is the next step? What are we supposed to do next? After you've been able to get the depreciation, what is the next step you're supposed to be able to undertake? Stephen, what is the next step? What is the next step? You prepare what we call what? An amortization schedule. From the amortization schedule, you'll be able to know the interest under the lease each and every period, and also you'll be able to know the non-current liability obligation under the lease, and also the current liability obligation under the lease for each and every year. And therefore, this is what you're actually going to do to present what? The lease amortization schedule. You can be able to present the lease amortization schedule. You can be able to present the lease amortization schedule. So you'll come up with the lease amortization schedule. So you'll come up with the step number 4, the amortization schedule. So from the amortization schedule, we say that you'll likely be able to get what? The interest, the non-current liability obligation, and the current liability obligation. The non-current liability obligation and the current liability obligation. And we said when you're having to present the amortization schedule for leases in arrears, it will look a bit different from the one for leases in what? In advance. And therefore, you normally start with what? The period. Then you'll have the balance brought down. Balance brought down. Remember, this one is actually lease payments having to be done in arrears. These payments having to be done in arrears. And therefore, first of all, once you have the balance brought down, you charge interest first of all, immediately. So after interest has actually been charged, is when now payment will likely be made. When you make payment, you have to know how much of the principal amount are you remaining with. How much of the principal amount are you remaining with? Then you need to know now what will be the balance carried down. What will be the balance carried down? Remember our figures, we are presenting them in shillings of what? Thousands. We need to indicate we are presenting them in shillings of thousands so that everyone can be able to know. We are not having to deal with dogs here or cows. We are dealing with money. We are not dealing with dogs or cows here. We are dealing with money. We are serious people. We deal with money, and not little money. It is in millions. It is in millions. How many periods do we have? We have 6 periods. So 1, 2, 3, 4, 5, 6. We can be able to present our amortization schedule like that. We can be able to present our amortization schedule like that. Our amortization schedule like that. Can be able to present our amortization schedule like that. Amortization schedule like that. So you have the last bit there you're not able to see, but I'll be able to adjust for you to be able to see the last bit for the last period, which is 6 years. 6 periods, not 6 years, but 6 periods. 6 periods, you have 6 periods there. So our lease liability is actually 60 million. Remember, there was not actually any advance payment. So what is actually due to be settled for the entire lease is actually 60 million. Is actually 60 million. And therefore, we'll put here 60 million. Remember, our figures are in thousands, so it will be 60,000, 60,000. So of course, interest is actually at what? At 10%. But of course, you have the payment. This is the easiest figure you can be able to place here. The payment of the rental payments, each and every period is 14 million. So you likely put 14 million. See how it is just looking easy. 14 million. Imagine this one, you just put the way it is. Just moving like that. 14 million going down because the rental payments are constant. They are just constant. How easy is this thing? How easy is this thing becoming? These rental payments are just constant. 14 million throughout. 14 million throughout, 14 million throughout, 14 million, 14 million, 14 million, up to the last one, 14 million. Up to the last one, it is still what, 14 million. So now we need to start having to fill our what, amortization schedule. We need to start having to fill our amortization schedule. So interest is actually at what? At 10%. Interest is actually at what? 10%. Is actually at 10%. That's what you've actually been told in the question. Not me having to guess that 10%. It is in the question. 10% of this one is quite simple. It is 6,000. 6 million or 6,000. So when they make the payment here, you see when they make the payment at the end of each and every period after 6 months, they are clobbering this interest, and part of the principal amount on this list. So they are clearing off this interest for that period and also clobbering part of what? This principal amount. So you have to know how much of the principal amount they're having to pay. How do you do it? You take this minus this. You'll be able to get 8,000. And these are when you take a loan, how it is normally settled. When you take a loan, this is how it is normally settled. When you make a payment each and every period, they clear the interest for that period. Then part of the principal amount also will be clobbered, will be paid. So when they made the payment of 14 million, they cleared this interest. So we have to know how much of the principal amount they are having to pay. You take this minus this, you'll get 8,000. Now, what is the balance carried down in terms of what? The lease liability. It is quite simple now. You can take what has been paid as the principal amount from what? The initial liability. You'll be able to get how much? 52,000. You'll get 52,000. So they are opening the next period with a lease liability of 52,000. The cycle continues on like that. Interest, 10%. It will be 5,200. When they pay 5,000, when they pay 14,000, they are clobbering this interest and part of the principal amount. You have to ask yourself how much of the principal amount this period they'll be clearing. You need to take this minus this. This seems to be 7,800, or how much is it? 8,800 or 7,800, which is which? 8,800. It will be 8,800. So they have clobbered of this principal amount. They are clobbering 8,800. And therefore, what is remaining as the lease liability? What is remaining as the lease liability? Charity, Reagan, Stella. What is remaining as the lease liability? You need to take this minus this Charity. You need to take this minus this. How much are you having to get? 43,200. 43,200. How easy is it now looking? That it is opening here. We put on 10%. It comes to 4,320. When they pay 14,000, there's part of the principal amount they are clearing. How much is it? There's part of the principal amount they're having to clear. How much is it? How much is it? 96.80. I can be able to see you are saying 96.80. You are saying 96, 80. 96.80. You are saying 96.80. 96.80. Then how much is having to remain as the balance carried down? 33,520. 33,520. I can say saying 33. Hope it is correct. I hope it is correct. 33,520. We put on interest, it will be 33,52. So how much of the principal amount are they paying? You take this minus this. How much will you get? You'll get how much? This minus this. I can see Stephen says 10,648. 10,648. So how much is remaining as the balance carried down? So now you need to take this minus this. 33,520 minus 10,648. You're getting how much? I can see you are saying 22,872. 22,872. So we open here 22,872. We have here, it will come to 22,87.2. 22,87.2. So you can just round off to that. So you can be able to say 22,87. Just say 22,87. So you take this minus this. to know how much of the principal amount they are paying. You take this minus this. How much of the principal amount are they having to pay? I can see 11,713. 11,713. So you need to now to take this minus this to know how much is the balance carried down by the end of the 5th year. $22,872 minus 11,713. You're getting 11,159. I can see you're saying 11,159. 11,159. So we open here with the 11,159. 11,159. So we put on 10%. It comes to 11,16. I think it is 11,16. 11,16. It comes to 11,16. 16. You minus this to know how much of the principal amount they are clearing. Just minus this. You are getting 12,864. 12,864. Ideally, what you're supposed to remain with here is supposed to be this exact figure. So that when you minus, this one should actually end up having to be 0. It's only that you see that examiner rounded off this figure, so you can't actually get exactly 0 there. But assuming we used our figure that we calculated, remember the one we got 60,973,000. You'll arrive at 0 here. It's because of this rounding off and the confusion of the examiner. So the lease liability is not that accurate. So when even you do the amortization schedule, you can't exactly arrive at 0 here. But assuming we are using that correct figure of ours, that it is the standard as how you're supposed to calculate the lease liability, then you would have actually been able to get 6973. When you do the same process, you'll actually realize this figure will be the same as this one. So that when you deduct, at the end of it all, by the end of this period, they have already cleared the lease in terms of the payment. But here you'll be able to get a very small figure difference. It's like around 1,000 and something. It's because of that rounding off effect by the examiner. So you want to be able to get exactly how much? Nail here. But under a normal amortization schedule, even in a loan, you normally arrive at 0 here. If you don't arrive at 0 here or almost 0 here, like in our situation here where we are rounding off, unajua amortization schedule yako umegonga nje. So you should be able to arrive at a figure close to what? Close to 0 at the end here. So that's what will likely happen regarding what? The amortization schedule. And see, you are not able to see down there. Let me adjust it for you a bit. Yeah, so once we have the amortization schedule, now we can actually be able to now get the interest for each and every period. When you have the amortization schedule, you can be able to identify the interest for each and every period. So remember, there are 3 years. There are 3 years. Remember, there are 3 years. So you likely pick for this first year. Remember, this one is year 1, year 2, year 3. So year 1, year 2, year 3. So if you want to know the total interest for the first year, you have to pick this figure. For the second year, you pick these figures. For the third year, you pick these figures. So remember, you are having to identify what? The interest. The interest. We are having to identify the interest. Then, after that, you'll likely be able to identify the non-current liability. How do you identify the non-current liability? Who can be able to tell us? If you are there in our very first class for leases, how did we say when the lease payments are having to be paid in arrears? How do you identify the non-current liability? How do you identify the non-current liability from the schedule? It is different with how you identify the one in advance. Like the one we did yesterday is not the same way you'll identify here. It is different. That's where also the difference arises. When you are preparing the schedule, how do you identify the non-current liability obligation? We said you pick what? The balance carried down from the second year. you pick the balance carried down from the second year. So if it happens, the lease payments are having to be paid in arrears. If it happens, so we can be able to write here, we can be able to identify our non-current liability obligation, our NCL obligation. Our NCL obligation. So how do you identify it? Remember, these are lease payments in what? In arrears, where we have lease payments in arrears, lease payments in arrears. We have the lease payments in arrears. So for the NCL obligation under the lease, or the non-current liability that will be paid by this lessee each and every year on this lease, or will have to be settled each and every year on this lease, you'll pick the balance carried down from second year, or you can say subsequent year. Remember, for the other one, we are picking the balance due. For the one in advance, you'll pick the balance carried down from the second year or from the subsequent year. So it means for this first year here, you see this first year here, this particular first year here, if you want to know the non-current liability obligation for the first year, we'll go to the second year and actually look at what the balance carried down. Our balance carried down is actually this amount here. And therefore, it will be the non-current liability obligation for the first year. It is that liability they won't be able to settle this year, but they'll be able to settle in the long term. It will likely be 22,872. So it means for this first year, the non-current liability obligation they'll be able to settle in the first year, which they'll be able to present in their financial statements, which means is a liability they're not having to settle immediately, they'll pay in future, will likely be this one, 22,872. If you want to know for the second year, you go to the subsequent year, you pick the one here. But of course, here we don't have anything. So it means that one is actually what? 0. It is 0. And therefore, also for third year, it is not there because even we don't have fourth year. So in the third year, this lease is coming to an end. So how can we be able to present an non-current liability yet? The lease is coming to an end. So it is not there. Then if you want to identify the current liability obligation, if the lease payments are having to be done what? In arrears, how do you identify it? How do you identify it? So in this case, you don't add the first half. Don't add. That is something you've been able to highlight there. Don't add. So now listen to the current liability obligation very keenly. For this one, I've told you don't add. Pick these figures here. Pick those figures there. But now listen to the current liability obligation. This one, you're actually going to pick what? The principal amount. Principal amount that was settled. The principal amount that was actually settled from the second year. Principal amount from second year. You pick the principal amount that was actually settled from the second year. And of course, here you can be able to see in second year, we have 2 principal amounts that were settled here. These ones now you add. You'll add them. You likely have to add them. You add to the principal amount that, remember these ones are being paid. Zinalipwa. Hii wanalipa June na hii wanakuja kulipa December. Ni zile pesa wanalipa. They are being paid. So you'll have to add the 2. But for the non-current liability obligation, pick the one at the end of the period or the second year and at the end of the third year. But now this one is the principal amount which they are actually paying. It becomes what? The total of the 2. So it means for this, the principal amount from the second year or subsequent year. Can people say subsequent year or the second year? Subsequent year. So it means for this particular year here, year 1, we'll pick these ones here. This plus this. For this year 2, we'll come and actually pick this plus this. They'll actually become what? Our current liability obligations in the statement of financial position. You have to be very keen. If the lease payments are having to be made in advance, it is different how you identify. Here we said you pick what? The balance due. Look at the question for yesterday. Look at the question for what? For yesterday. You have to take to note the difference. It shouldn't actually confuse you. The one in advance, you said you pick what? The balance due. Then you said you pick what? The payments. The payments that were made. The payments that were actually done what? Made. You have to take note of the difference. Then also, take note of how the schedule looks like. The schedule for the one the payments are being done in advance. It is a bit different. That one, we start with the period immediately. Then we go to the balance brought down. The payment comes immediately here. The payment comes immediately here. Then we'll have the balance due here. After the balance due, at the end of the period, is when we charge interest here. Then now we'll have the balance carried down. We'll have the balance carried down. So the schedule looks what? A bit different. Looks a bit what? Different. You have to take note of that. You have to take note of that. So just be very keen. Just be very keen. Be very keen, be very keen, be very keen. Be very keen as to how the schedule looks like, and be very keen as to how you identify the NCL and the CL obligation. If you look at yesterday's question and today, you are good to go. The steps are just the same. You start with what? Computation of the fair value of the lease liability. You determine the ROA. You determine depreciation. You come up with an amortization schedule. You have to be very keen that the schedule looks a bit different. How you identify NCL and the CL is a bit different. Then also, when you're having to compute the fair value of the lease liability, if it is lease payments in advance, under the periods, you less one period. It's because that payment has already been received. You shouldn't discount what has already been settled today when we are commencing the lease. It is already in the present. So the remaining payments in future, which are less one period, are the ones you discount under leases in advance. If they're actually in arrears, take the entire periods, like this one. We've taken all the 6 periods. Assuming these rental payments are having to be done in advance, one period 𝗖𝗙𝗙𝗘𝗏. Because when you are commencing the lease, for the first period, that amount is already in the present. You don't discount. What is discounting? Getting a value in future to be present today. You can't discount what has already been paid on the first day on commencement of the lease. That's why for lease payments in advance, one period 𝗖𝗙𝗙𝗏. Don't forget. That's where you luckily end up having to get to do what? To confuse. That's where you luckily end up having to do what? To confuse. So now, once you've already been able to identify this, we can be able to come up with our financial statements extracts. Let's see our financial statements extracts. Let's see our financial statements extracts. Our financial statements extracts. Let's very quickly see our financial statements extracts. So we can be able to start with it. It is Kamulu Limited. So Kamulu Limited. Income statement extracts. It is as at what period? It is as at what period? They have said for how many periods? They have said for 2009 and 2010. For only just 2 years. They have said for 2009, it is as at 31st year ended 31st of December. So you have 2 years, 2009, and of course, 2010. So only just 2 years, only just 2 years. So we have the lease commenced on 1st of January. In the income statement, we'll be able to present 2 expenses. So we'll present 2 expenses. You can be able to indicate here shillings in thousands. Shillings in thousands. The expenses we'll be able to present, it is depreciation, which you've seen, it is 20,000. So tumesema kila mwaka tumecalculate under step number 2 inakuja 20,000. So kila mwaka, it is actually 20,000. Another one is actually interest. Interest you have to add. You have to add. So you have to add the 2 periods, for the 2 periods in each and every year. So how much are you getting as the interest here? You need to add the 2 interests. How much are you getting for the first period there? How much are you able to? I can see someone is asking for the notes. So if you want to get the notes, I can highly advise you. So I've seen this one happen even in my previous classes. When you ask for the notes, people rarely send you notes. What you need to do, you need to go watch the video and write the notes. Utauliza notes hapo kwa grupu utapata. Hawatatuma. So if you want to be able to get the notes, just go to the video and actually start writing them. And in fact, through that process, you'll be able to learn more. Other than someone having to send you notes, probably handwriting yake ni mbaya, kama ya daktari. Ama kuna figure ali miss out, mwalimu ali explain hivi akaandika hivi. So the best thing, you just go to the video and just review it. You can even increase the speed on the LMS. You can do it ×2. Hata kama mwalimu atakuwa na rapa hapo. If you put a speed of ×2, mwalimu atakuwa rapa hapo, but you'll likely be getting something. So that's the best approach. So how much are you getting? 11,200, 11,200. What about for this other year? 2010. What about for 2010? Charity, what about for 2010? Interest is how much? So remember, you have two expenses, depreciation and interest. You add for the 2 periods because each and every year you're going to 2 periods to really. Semi-annually. The interest is being paid semi-annually. 76.72. 76.72. And of course, you would have actually been able to complete what your extract. Remember, this one is an extract. Is an extract. You're just extracting from the income statement of this Kamundu regarding these lists. How are they having to account for it? And that's how you present what the extract. Na tumemaliza. Tunataka kurap ama tufanyaje? Or we present the other one here. We can be able to present the other one here. Or let me just present here. I hope you are through, because I want now to present the statement of financial position extract. Kamundu Limited statement of financial position extract. This one is as at 31st of December 2009 and 2010. But now here we are not presenting expenses. Hapa tuna deal na ma-assets. Hapa tuna deal na ma-assets na ma-liabilities. Ma-assets na ma-liabilities. Tuna deal na ma-assets na ma-liabilities. So we have the 2 years, still 2009. And of course, 2010. We can say shillings in thousands, like that. 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 So we'll start with the non-current assets. We'll start with the non-current assets. We can start with the non-current assets. Non-current assets. So we'll say here, non-current assets. So of course, you'll be able to present the ROA, right of use of asset, which is actually what 60. As what the examiner has given us, it is actually 60. But now we have the accumulated depreciation. For the first year, hii asset ina lose 20,000. Hiyo tulikuwa tushaona. Pale kwa step yetu, step number 3, unakumbuka hapo mbithi? Mbithi unakumbuka hapo. So you just remember this one is accumulated. And therefore, when you go to the second year, you have to add for the first year and second year. That is what you mean by having to accumulate. So it will likely be 40,000. And therefore, what are you remaining with as the value of this ROA? Right of use of asset. Someone is asking, what is ROA? ROA means right of use of the asset. The lessee, ule mtu analisi your assets. Imagine, according to IFRS number 16, huwa anaipresent kwa accounts zake. Imagine si asset yake, but IFRS number 16 requires, if it is a finance lease, the lessee, mwenye amechukua your asset yenye si yake, anapresent as an non-current asset. Huwa anaipresent, anaipea kajina kazuri. You don't just call it anyhow an asset. You give it a nice name. What is this nice name? Right of use of asset. You've just been given a right to use this asset, but ideally you're also presenting it in your books of accounts as a non-current asset. Unaipea kajina kazuri. You can't just call it a plant or a machine. A very nice name. Right of use of asset. Ama ROA. Ukitaka kushtua mtu pia unamwambia ROA. Anashangaa ROA ni nini? What is ROA? Right of use of asset. So this one will likely be what? 20,000. 20,000, like that. And of course, you'd have completed the part of what? Non-current assets. Tunaenda non-current liabilities. Non-current liabilities. So you have what? The lease obligation. The lease obligation, of course, you only have for the first year. Ilikuwa inakuja ngapi? 20? Tulikuwa tumesema ni ngapi? 20 what? 20? Tulikuwa tumeidentify ilikuwa 20. 22,872. 22,872. Hapa hatuna. In the third year hakuna kitu. Kwa ile schedule yetu tumetengeneza third. Tumesema tuna pick the subsequent year. We pick what? The subsequent year, the balance carried down in the subsequent year. So in the first year, the subsequent year, the balance carried down in 22,872 inakuja hapa. In the 2010, the third year hakuna kitu. Sini bure hapo. Wewe, tunaweka tu dash. Haya, tunakuja current liabilities. Current liabilities. It is still what? A lease obligation. Lease obligation. Hii tumesema you still pick what? For the subsequent year. And what are you having to pick? You're having to pick what? The principal amount. The principal amount. The principal amount. So you need to add them. For 209, you pick the ones for 2010 and add them. So how much do you get when you add the ones for 2010 here? How much do you get when you add for the ones for 2010? When you add the ones for 2010, unapata ngapi? Mbili zile za 2010, we're picking for this from the subsequent year, the principal amount that was paid. You add the two, I can see 2328. This is from Steve-O. Steve-O and Latifa are saying 2328. Then for second year, you pick the one for third year. How much are you getting when you add the two? For second year, you pick the one for third year. How much are you having to get when you add? Napata ngapi? You are getting? You're getting 24,597. 24,597. And of course, you would have actually been able to present what the examiner required. That is the extract of the statement of financial position. So you've already cleared that question. So we can take a break. Let's take a break. Then when we come, I want to introduce another area under assets and liabilities. Remember, we are still in topic number 1. We are still in what? Topic number 1. So you've just covered what? Leases. Leases. I'll give you another exercise. You actually try also on what? On leases today. So over the weekend, you do something about what? Leases. But now when we come after the break, I want to introduce another area. We refer to it as what? Income taxes. It is still under topic number 1. It is still under topic number 1. So that's what I want us. We do what? We introduce income taxes. So we'll just be clobbering topic by topic. Topic 1, topic 2, topic 3, topic 4, as we go on like that until we complete the syllabus. Mimi huwa si mix vitu. I don't want those confusions. We start with topic 8, then we go to 4, then 3. Those are confusions which I don't like. So I just go step by step. We are still in topic number 1. So the area I want us now, we look at under topic number 1 is what we call income taxes. Income taxes. So you can actually be able to write income taxes as another subtopic under topic number 1, which I want us we look at. We'll be able to introduce it, but we'll delve deeper into it tomorrow. So a break of 5 minutes, then we come back. Yes, welcome back. So confirm whether we can proceed. Can we continue? Or people are still on the break? Can we proceed? Yes, I can see Margaret says yes. I can see people are saying yes. User says yes. Barnabas, what do you say? Yes, I can see you are saying yes, yes, yes. So I want us to start looking at another area in topic number 1. It is referred to as income taxes. Income taxes. But before we write something about income taxes, let me explain something here. Let me explain something here. So when you talk about income taxes, just from the term tax, this term tax, you are actually so much familiar with it. It is what we actually end up having to pay what? Government. What you are actually obligated to pay what? The government. For example, in Kenya, we pay our taxes to the Kenya Revenue Authority. So under this particular standard here, IS number 12, income taxes are usually comprised of 2. The income taxes that will likely be called upon to settle to the taxman usually comprise of 2. Number 1, we have what we call the current tax. We have what we call the current tax. Number 2, we have what we call the deferred tax. Deferred tax. So just from the term itself, current tax is the tax that will be settled by a company in the current year. This is what you normally provide in your books of accounts each and every year to be paid to the taxman. In public finance and taxation, you'll likely be called upon. They do what we call an estimate. Actually, an estimate. Then they actually end up having to do what? Place 30% on that estimate of the income. Then it is normally paid as what? As an installment tax. So that's what the tax for the current year. That has to do what? To be settled to the taxman. But now, according to IS number 12, it happens that when the taxman, there are 2 people here. There's the taxman, and then there's that accountant who is seated behind the books of the company. There's the taxman, who is KRA, who determines how much you'll end up having to pay as taxes. And then there's that accountant in the company who's preparing the books of accounts. What you have to realize is that when the taxman is having to determine the profit under which you'll be taxed, his computations are usually different from what the accountant had actually prepared in the books of accounts. Or in short, for the accountant, he'll likely be looking at what? The accounting profits. For the taxman, he'll be looking for what we call what? The taxable profits. Someone who has already done public finance and taxation is really having to understand what I'm having to mean here. It is that when the taxman wants to tax a company, what had actually been accounted for as profits by the accountant is not what they'll be able to consider. They'll have to do another recomputation as to what we actually normally call what? The taxable profits. For example, there are those expenses that will likely end up having to be recognized by the accountant that will be irrelevant to this other side. Alternatively, those expenses will still actually appear this other side of the taxman, but they won't have a similar term, they won't have a similar estimation or a similar computation as to what the accountant considered as an expense. A casing example. For example, for the accountant, on loss of value of assets, he'll likely be calculating depreciation. Or maybe what? Impairment. For the taxman, he'll not be calculating depreciation. He'll use a very nice term. We call it what? Is it wear and tear? Wear and tear. Or allowances, or no, building allowances. So here there's no that kind of an aspect. Here there likely be something we call what? Wear and tear. So you might realize the accountant was using to depreciate an asset at 10%. But the rates provided for wear and tear on loss of value of that asset by the taxman are different. It is not 10%, because for him, his language is not depreciation on an asset. His language is wear and tear. And therefore, it normally brings about differences. with how the accounting profits are determined, and with how the taxman profits are actually determined. These differences, we give them a special name under IS number 12. We call them temporary differences. And therefore, as a result of these temporary differences, some of the tax that was to be settled today might not actually end up having to be settled by the company. It will likely be settled in future. And now this tax, we normally call it the deferred tax. For example, those who have done public finance and taxation, when the teacher is having to tell you, you are supposed to determine the taxable profits of the company or taxation of companies, he'll tell you for depreciation, we are going to add back. Because it's not an expense, the taxman normally recognizes when he's calculating what? The taxable profits to be taxed at 30%. So you'll be told, like, depreciation, you add back. I don't know, allowance for bad debts, I don't know, you add back. Those kind of expenses, because the taxman doesn't recognize them as expenses. For him, he's using a different language. So you likely indeed add back the depreciation to correct the profits to be taxed by the taxman. But now, ideally, at the other end, he'll still reduce them by having to do what? Recognize wear and tear. Like on a building or maybe equipment, you'll say depreciation, you as an accountant. But for him, he'll tell you, add back that depreciation for that equipment. The language I want you to use when you're calculating my tax, the profit to be taxed at my end, I want you to use wear and tear on equipment. And therefore, you realize, without the taxman normally computes the profits to be taxed in a company, it is different from how the accountant will end up having to compute the profits to be taxed, or the accounting profits that will be determined for the company. And as a result of this, it normally brings about what? Differences. These differences, under income taxes, we're going to use the term what? Temporary differences. Through these temporary differences, then it gives rise to what we call what? Taxes that you won't settle in the current year, but you'll likely be called upon by the taxman to settle in future, or you might actually end up having to claim from the taxman in future. We call them what? Deferred taxes. And therefore, that's what we mean by what? The current tax. And what we mean by what? By the deferred tax. So before we go to the calculation, we can be able to write a few things here. Let's write some nice things here before we go to the mathematics. Before we go to the detailed mathematics of it, let's write some nice things here about income taxes. So you can be able to write this about income taxes. Write this about income taxes. Write this, income taxes. You can write income taxes comprise of, income taxes comprise of, income taxes comprise of. You are now writing, where Regan, we are writing income taxes comprise of the current tax, comprise of the current tax, income taxes comprise of the current tax, and the deferred tax. Income taxes comprise of the current tax and the deferred tax. Deferred tax. Deferred namna this. Deferred namna this. Deferred. Deferred namna this. Sarah. Deferred namna this. Sarah. Deferred namna that. Deferred tax. Deferred tax. Deferred tax. Then you write this. So I want you to write some definition of terms. Definition of terms. Write a small heading, definition of terms. Definition of terms. Definition of terms. So the first term I want us to define. The first term I want us to define. It is what we call what? It is what we call the income tax. You can be able to just write income tax, the first term. Let's define income tax. Right, the first term, which is actually income tax. Then you define it like this, semicolon. This includes all domestic. This includes all domestic and foreign taxes. This includes all domestic and foreign taxes based on the profits of the company. This includes all domestic and foreign taxes based on the profits of the company. This includes all domestic and foreign taxes based on the profits of the company. Based on the profits of the company. Based on the profits of the company. Then the next term, I want you to write current tax. Current tax, the next term is actually current tax. The next term is actually current tax. You write this about current tax. It is the actual tax payable. It is the actual tax payable. It is the actual tax payable by a company. It is the actual tax payable by a company based on the profit realized. Based on the profit realized. Based on the profit realized in a financial year. It is the actual tax payable by a company based on the profit realized in a financial year. Based on the profit realized in a financial year. Based on the profit realized in a financial year. Full stop. Then you write the next term, deferred tax. The next term, number 3, is deferred tax. Deferred tax. You write this about deferred tax. Deferred tax. It is tax payable in future. It is tax payable in future. It is tax payable in future, which arises. It is tax payable in future, which arises. Which arises as a result of. It is tax payable in future, which arises as a result of. As a result of the differences. As a result of the differences in. As a result of the differences in accounting profits. Accounting profits. The differences in accounting profits and taxable profits. 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 Or temporary differences. Accounting profits and taxable profits or temporary differences. Temporary differences. Temporary differences. Or temporary differences. Temporary differences. Temporary differences. Temporary differences. Temporary differences. Temporary difference. Then you write the next term. The next term, which is now this one now. Temporary differences. You write these temporary differences. The next term I want you to write so that we define it. Temporary differences. Then you write this about temporary differences. It is the difference between. It is the difference between. It is the difference between the carrying amount. The carrying amount and the tax base. It is the difference between the carrying amount, the carrying amount, carrying amount and the tax base. And the tax base of an asset. And the tax base over an asset or liability. And the tax base of an asset or liability. The tax base of an asset or liability. The tax base of an asset or liability. So there are things you're having to say, your carrying amount under the tax base. So these are now like the figures I was having to talk about. You see, like for the assets, what would have actually been presented in the books of accounts is the value of that asset as to how it is carried, just from the term carried, how it is carried in the books of accounts. It is carried at a value of 60 million in the books of accounts. But now the taxman won't recognize that value as to how it is actually carried in the books of accounts. For him, he's recognizing another different value, which is the tax base. So the tax base is actually based on the taxman. The carrying amount is actually based on the accountant, and that is what is actually presented, is what is being carried. That's the term carried. Is what's being carried in the books of accounts. How much is it? But now what will be the taxman be able to consider as the value of that asset? It will be different. I've already told you part of the differences. For him, he's using depreciation to get the carrying amount of what? Of the assets. For the taxman, he's not using what? Depreciation. He's actually recognizing wear and tear. And for him now, his figures are tax bases. But for these accountant, these figures are the ones being carried in the books of accounts at a net book value. And that's what he's having to recognize in his books. As a result of this, then now arises what you're having to call what? The temporary differences. The temporary differences. The temporary differences. Then you write, just under that, you write therefore, deferred tax, just under that definition, you write, therefore, deferred tax is equals to the tax rate multiplied by the temporary differences. Multiply by the temporary differences. The way you actually end up having to calculate current tax, where you take 30% of the profits realized. Now, when you are computing deferred tax, you can write in red, or you can be able to super highlight. You can super highlight. Deferred tax is equals you take the tax rate, which obviously in Kenya is normally at 30%. You multiply with what you would have gotten as temporary differences. When you try to compare the figures of the accountant and the taxman, what are you getting as the difference? You calculate 30% on that difference, you'd be able to get the tax that will have to be settled in future, or the claim you'll be able to make as a company in future. The claim you'll be able to make as a company in future. So the carrying amount is equals to net book value. Yes, that is true. Is the value at which the assets are being carried in the books of accounts. It is normally at net book value. It is normally at what? Net book value. Net book value. It is normally at what? At net book value. So I want us to be able to do a very simple example here. Let's look at a very simple example here. So write example. Write a simple example here. Example, then you write this. Example, you write this. Assume a company has an equipment. Assume a company has an equipment of, assume a company has an equipment of which value? The cost of this equipment, the cost of this equipment is, let's say, for example, 4,000. The cost is actually 4,000. 4,000. Then depreciation is, let's say, for example, 800. Is 800. Depreciation is actually 800. And then we have wear and tear. Wear and tear. Wear and tear of, let's say, for example, 200 or 600. Let's use 600. 600. So determine the temporary difference. Determine the TD. You must now start getting used to having to call it TD. Determine the TD or temporary difference. Determine the TD or temporary difference. So the question says determine the TD or temporary difference. Determine the TD or temporary difference. Hope you are seeing it. Assume a company has an equipment of cost 4,000. Depreciation on this equipment 800. Wear and tear 600. Determine the temporary differences. Temporary differences. So you'll say the answer, can write the answer here. Answer, can be able to say the answer. TD, temporary difference, is equals to the carrying amount. We said it is the difference between carrying amount and the tax base. And this is how you normally calculate it. The TD is normally equal to the carrying amount. You minus what? The tax base. The tax base. And of course, we've said the carrying amount are usually based on the accountant computations. Is what the accountant is presenting. For him, he'll be able to present what? The net book value. The taxman doesn't understand depreciation. For him, he understands what? Wear and tear. And therefore, for him, he'll be presenting what? The tax base figures. The tax base figures. And therefore, it means our temporary difference here will be equal to what? Remember, our friend has already told us at what value is this asset being carried in the books of accounts. It is at the net book value. And therefore, it means we'll be able to take this minus this. We'll get the net book value. It will be 4,000 minus 800. Then we minus the tax base. For the taxman, he doesn't understand the language of what? Depreciation. For him, he understands wear and tear. And therefore, the wear and tear is different. So he'll be able to just place what? The loss of value on this asset to be wear and tear. It will be 4,000 minus 600. 4,000 minus 600, like that. And therefore, we'll have 3,200 minus 3,200 minus 3,400. 3,400. What are you getting? It will be equal to what? It will be equal to negative 200. 200. It will be equal to negative 200. It will be equal to negative 200. You can be able to write another term here because I want to explain it. We'll call this one what? You see, it's a temporary difference. But now it is negative. We normally call it deductible. Deductible. We normally call it deductible temporary difference. We normally call it deductible temporary difference. It is negative. We normally call it deductible temporary difference because it is negative. When you take the carrying amount minus the tax base, you're getting a negative figure. If you get a positive figure, we call it taxable temporary difference. We call it taxable temporary difference. Taxable temporary difference. And therefore, you can be able to write an NB just after that, a note, NB after that, an NB after that, write an NB after that, a note, you write a note. If the temporary difference is negative, if the temporary difference is negative, if the temporary difference is negative, i.e., the tax base is more than the carrying amount. If the temporary difference is negative, i.e., the tax base is more than, the tax base is more than, the tax base is more than the carrying amount. The tax base is more than the carrying amount. The tax base is more than the carrying amount, comma, comma. It will give rise to, it will give rise to, it will give rise to a deferred tax asset. It will give rise to a deferred tax asset. It will give rise to a deferred tax asset. It will give rise to a deferred tax asset. It will give rise to a deferred tax asset. It will give rise to a deferred tax asset. Then you write still NB. Of that one, you can be able to write as NB number 1. Then you go to NB number 2. NB number 2, you write this. NB number 2, you write this. If the temporary difference is positive, now it is the opposite. If the temporary difference is positive, if the temporary difference is positive, i.e., the carrying amount is more than, the carrying amount is more than the tax base. The carrying amount is more than the tax base. If the temporary difference is positive, i.e., the carrying amount is more than the tax base, it will give rise to a deferred tax liability. It will give rise to a deferred tax liability. It will give rise to a deferred tax liability. A deferred tax liability. So what it means, ideally, if you actually do your computations, carrying amount, tax base, comparing, then you actually overall end up having to get a positive temporary difference. You get a positive temporary difference. Hii inamaanisha itakuletea liability. You'll now be the one liable to pay the taxman. Itakuletea liability. But if it happens, you compare carrying amount, tax bases, then you realize the tax bases are always more. It'll actually give it rise to what? Negative temporary difference. And therefore it'll give you what? A tax asset. It'll give rise to what we call a tax asset. And therefore for these ones, we'll actually call them taxable temporary differences. These ones are deductible temporary differences. They'll give rise to what we call what? A deferred tax asset. It's like now it will be the one you having to claim from the taxman, not the taxman having to claim from you. So that's what will likely happen. So if you compare what the taxman did and the accountant did, you get positives. Those are now what we call what? Taxable temporary differences. If it happens, you do the comparison and you actually realize what? A negative, you call them deductible temporary differences. They give rise to what we call what? A deferred tax asset. A deferred tax asset. So hapo deferred tax asset na deferred tax liability, shikia tu hapo kwanza. I'll be able to elaborate on it further when now we start having to open what? The ledger accounts. Now I'll be able to tell you, you can see this one you're having to put on the debit side. This one you're having to put on the credit side. And this account is actually 2 in 1. When I do the full illustration now, I'll be able to tell you at that point why we're having to say this one is actually negative, giving rise to an asset. This one is positive, giving rise to what? To a liability. But now there's a new term that we've already been able to introduce here. You have to put it on record. And therefore, write the next term, which you're having to call it what? I don't know it is number what? Is it number 5? Call it the tax base. Right? Tax base. We mentioned it so many times. Put it on record. Put it on record as evidence. Put it on record as evidence. Number 5, tax base. Then you write this about tax base. It is the amount attributable. It is the amount attributable to an asset or liability. It is the amount attributable to an asset or liability for tax purposes. It is the amount attributable to an asset or a liability for tax purposes. It is the amount attributable to an asset or a liability for tax purposes. Or, just in simple terms or the layman's language, it is what? Or it is what the taxman will consider. You can say it is the amount attributable to an asset or a liability for tax purposes. Or it is what the taxman will consider. It is what the taxman will consider as the value of an asset or a liability. It is what the taxman will consider as the value of an asset or a liability. For him, he knows wear and tear. But for you, the accountant, you know the carrying amount. Now it gives what? Temporary differences, which will give rise to deferred taxes. Give rise to deferred taxes. Then you can just briefly define these two terms, the one you've talked about. The next time you can write number is number 6, deferred tax liability. Just briefly define them before we'll be able to open accounts. Briefly define them. Number 6, deferred tax liability. Right? Deferred tax liability. The deferred tax liability, which you've said it arises as a result of what? The positive temporary differences. So write that term, then we define it briefly. Deferred tax liability, right? Something about it, write it like this. This is the amount of income taxes. This is the amount of income taxes payable. This is the amount of income taxes payable in future period. This is the amount of income taxes payable in the future period in respect of taxable temporary differences. It is the amount of income taxes payable in future period in respect of taxable temporary differences, which you've said arise as a result of what? Positives. Positives. When the carrying amount is more than what? The tax base. It gives you positives. So when you get the positives, we call them taxable temporary differences. They'll give rise to a tax liability. Then the next term, the last one, before we say hure and go to sleep, number 7, deferred tax asset. Deferred tax asset. I can see Regan says pardon. So you've said the deferred tax liability is the amount of income taxes payable in the future period in respect of taxable temporary differences. In respect of taxable temporary differences. Then number 7, the last one, deferred tax asset. Deferred tax asset, right? This is about deferred tax asset. It is the amount of income taxes recoverable. It is the amount of income taxes now recoverable. Amount of income taxes recoverable in the future period. In respect of deductible temporary differences. In respect of deductible temporary differences. It is the amount of income taxes recoverable in future in respect of deductible temporary differences. In respect of deductible temporary differences. And therefore, that's what we mean by what? Deferred tax asset. So we can actually end there. So tomorrow, we'll now start having to look at different illustrations as to how now we do the computations to be able to know what can be the deferred tax liability or deferred tax assets. Any question you can be able to ask before we go to sleep or we say hure. But of course, we are not having to go to sleep, some of us. It is Furahi Day. It is Furahi Day, so it is Furahi Day. Any question? Any question, Regan? Do you have any question? Barnabas. Barnabas? Eve, you mean you haven't actually gotten the last statement? Barnabas is asking my name. He's asking about my name. So let me first of all clear that statement for our friend there on income taxes. So you said deferred tax asset. It is an amount of income taxes recoverable in future period in respect of deductible temporary differences. You've got it in now, Eva. I think we are now good to go. In respect of deductible temporary differences. In respect of deductible temporary differences. So this is my name. So this is my name, Job Lubaha Kenyani. Job Lubaha Kenyani is my name. Any other question? Job Lubaha Kenyani. Job Lubaha Kenyani. So I'll be the one having to teach you FR up to the end of the semester. So hope you'll be able to have a good experience, great experience. as we move on. I also teach company law. So if you're also in company law, we'll likely be meeting also virtually for company law unit. I still teach that one. My qualifications, I'm a CPA, a graduate of BBM, and also finalizing on my master's degree in strategic management. I teach at RCM intermediate level units and also advanced level units. So we still be able to meet in advanced level. If it happens, you'll still be at RCM or I'll still be at RCM. So I teach the intermediate units and also advanced level units. Yeah, so that's it.